All right, so welcome to the session today, session 5 in our discussion for the March 2026 examination. And we are going to be getting excited to look at the final part of our discussion, which is audit reporting, and also get ourselves excited to touch on some few key issues that we need to understand when it comes to advanced audit and assurance. And so let me bring up my screen quickly and then we can get excited into the discussion. Now, a quick wrap up of what we discussed in the previous session. We mentioned that when it comes to the audits work that we are doing as auditors, the first level is acceptance. So somebody has called us, nominated us to come and audit their financial statement. Good news. So we went through the various things we must understand when it comes to the acceptance procedures, and we saw the various things there in respect of that. Then we came to the second level and said, okay, now that we have accepted the audit, we need to plan the audit. And so we came to audit planning and risk assessment and discussed the various issues about business risks and audit risks, looked at the various things we must understand there. Then the third layer was where we were on in the previous session, and that is audit procedures and audit documentation. And we discussed the various things we must understand when it comes to audit procedures and audit documentation. The last one, or the fourth area, is going to be audit reporting, where we get into the audit opinion and conclusion of the audit, which is what we're going to be getting into today in the discussion. Now, we mentioned that when it comes to dealing with the audit procedures, we are going to be using the 5 vowel sounds, A, E, I, O, U. And that is going to be guiding us on how we are going to be carrying out our work as auditors. We said the A is analytical procedures. And this has to do with comparing data to find trends, anomalies, differences in the data. Enquiry, here we are seeking information from knowledgeable persons. And so we are asking questions to find out what is going on or get information about a specific subject matter issue. I is inspection. This has to do with examining records or even physical examination of assets or an event that has taken place in respect of the subject matter under consideration. And that is very important there in respect of that. Then we came to the issue about O, which is observation. What are we observing? This is watching a process being done or a procedure being performed, and that is observation. So we're going to be sitting down, and this is where we can talk about a vouching process, where we put a dummy transaction into the internal control systems of the entity and find out whether the transaction will go through the system the way the entity has labeled it out or has indicated that the system is working. And that is the issue in respect of audit procedures. Then we came to observation. Then we came to recalculation and reperformance. And this is where we said, as auditors, we are going to be doing everything ourselves again to find out whether arithmetically the calculation is well done, and then whether the financial statement has been presented in the manner that is supposed to be presented. And so we mentioned that whatever subject matter question that we are looking at, we are either going to be doing analytical procedures, inquiry, inspection, observation, recalculation, and reperformance. But here is the trick. We mentioned that we can derive a lot of our answers just from inquiries and inspection. It doesn't matter the subject matter in question, we can get inquiries, inspection, and produce quite a number of answers from these two areas. And we saw that in respect of the question that we considered. And so we discussed the various issues that we need to understand there. And then we came to looking at the assertions that we are going to be testing. So we said when it comes to dealing with the audit procedures, it's either we are going to be coming from the assertions being tested, or we will come from the realms of the accounting standards. And we said it depends on where you are coming from. And so if it is about assertions are simply the characteristics that need to be tested to ensure financial records are correct. And so we categorize the assertions into three, and that can also be termed as the ACCA cover, usually. And so under the assertions to be tested, there are a number of things that we need to understand there. We can look at the profit or loss. We can look at a statement of financial position and then the notes and other disclosures. So again, when it comes to the subject matter item, we must ask ourselves, is this a P&L issue? Is this a position issue? Or is a disclosure issue? Because that is going to be guiding us on how we are going to be presenting ourselves in the financial statement. So let's come to the profit or loss. In the profit or loss, this is where we're talking about transactions and events. So for the transactions and events, we're going to be testing for the assertion occurrence. Did the transaction take place? Completeness. Have we recorded all the transactions that we are expected to be recording or to record in the financial statement? Accuracy. Have we recorded all the transactions at the appropriate amount at which they are supposed to be carried? Cutoff. The principle of cutoff is simply to verify whether the transactions relates to the accounting year ended under review. Because we said there is a tendency, especially when it comes to issues about revenue, that the entity may decide to sign a contract and recognize the revenue in the current year, contrary to the guiding principle in IFRS 15, revenue from contract with customers. So cutoff, we want to look at, is the financial statement including information about transactions relating to only this current year? Then classification, has the entity appropriately classified the transactions in its books? These are the things you must understand when we talk about the transactions and events. Then account balances at the reporting date. So we said if we are asked to audit something that is in the statement of financial position, so it could be depreciation, it could be trade receivables, bank balance, inventory, property, plant, and equipment. Whatever we are auditing that is on the face of the statement of financial position, we could then test for these assertions. And these include the issue in respect of, please give me a sec. And this include issues in respect of, what am I having? Just give me a moment, just give me a moment. I'm having a problem with one of my feeds here. Please give me a sec. Let me see if I can resolve this. If not, I could just jump in and go. Okay, let's go. So when it comes to accounts at the reporting date, these are the things we are looking at. One, we're going to be looking at the issue in respect of existence. So if it is inventory, then you need to go do an inspection, right? To go and see whether the inventory is there. If it is PPE, physical examination, you need to go and see whether the inventories are there, generally in that regard. Rights and obligations, we said, relates to assets and liabilities. Completeness is the balance sheet including all the transactions that are to be included. Then valuation and allocation. Have we been able to value the items well? Are they carried at the appropriate amount that they are supposed to be carried? So these are the assertions to be tested for in the statement of financial position. Then we came to our master plan question that we use to crystallize the principle, which is Omega Limited. And we saw 3 key scenarios on how the principle can be applied when it comes to writing out the audit procedures in respect of that. But then we concluded a discussion with the audit evidence because we said, hey, everything we are doing as auditors is to gather sufficient and appropriate audit evidence. And we said that sufficient means the quantity, the amount of the evidence we need. Appropriateness has to do with the quality of the evidence that we need in respect of that. And so we said for the auditor to rely on an evidence, which is the quality of the evidence, what the auditor generates himself or herself, so evidence directly obtained by the auditor, we said is more reliable. Evidence obtained from an independent third party is more reliable. Documentary evidence is more reliable than oral evidence. And so we said, even in the discussion that we will have with management and those charged with governance orally, whilst they are giving us their response, we're going to be documenting it. When we finish, we will present it to them. Sir, this was a question I asked you. These are the responses you gave. Can you cross-check if this is what you meant and sign it for me? And that becomes part of our audit documentation or working paper, so that in case something happens later on after we finish our work and they say we didn't do our job well or we didn't see something, we can then use that as an evidence and say, hey, we asked management. This was what they told us. This is the signature of the CEO. This is the signature of the key knowledgeable person that we spoke with. That is documentary evidence in respect of that. So these are the things that we spoke about when it comes to dealing with audit evidence and audit procedures. Now, let's bring everything home. So if you pay attention closely again, we've accepted to carry out the audit. We have planned our audit in the manner that is expected to be planned. We have carried out the audit procedures and gathered evidence. Now we come to the end of the audit, and that is going to be the reporting part. Please stay with me because we had a little freestyle on this in the previous session. If you remember, we said when it comes to audit reporting, in this area that is 15 marks or 20 marks, depending on how excited the examiner is, we will be going there and the examiner is going to present us with one of these areas here. Stay with me. Subsequent event, we spoke about that in the previous session. Going concern is here, review of other documents, audit opinion, and then the audit report itself. So we're now going to be going through these one after the other as we build our discussion generally in that regard. First, let's look at review of other documents. So review of other documents. You must understand that as auditors, primarily, what we are there to do is to audit the financial statement. That's our job. But you see, we don't just audit financial statement and go away. We don't just bury ourselves into statement of profit or loss, statement of financial position, statement of changes in equity, the notes to the financial statement, and say, clap for us, contembre, froye, and go away. No. Although we are not going to be reporting on these other documents, they aid us and give us evidence when carrying out our work as auditors. So what are these other documents that auditors are going to be reviewing? The first one is the management, or if you want, the board minutes. And I want you to stay with me carefully because you're going to be understanding why we are going to be looking at these documents. The second one is going to be sustainability report. sustainability directors and other reports. Okay, maybe various committees report. We could be interested in that in respect of that as we proceed in the discussion. So that is another document that we are going to be looking at. Now, here is the deal. So say we go to the company, and as part of the things during the year, we are told that, oh, the entity acquired an asset. So we saw that PPE went up by, so 20x5, 20x6, PPE. 20x5, the PPE was, say, 10 million. 20x6, the PPE is 25 million. So we do analytical procedures. The analytical procedure says, the PPE has gone up by how much? 150% or more. Okay. What do? We now inquire from management. Hey, management, how did the PPE go up? Because PPE going up as auditors can be because of revaluation of assets, and there is upward revaluation of assets, or it could be because the entity acquired some assets during the year. Even the acquisition option, it could be either we leased the asset or it was an outright purchase. So we asked management, what happened? The management said, oh, we bought new assets during the year. So the increase in the PPE, whatever that is happening to the PPE, is because of the acquisition we had. Okay. As auditors, we would have to dig further to find evidence that will corroborate what management is saying. If there is going to be significant acquisition of assets like this, from 10 million to 25 million, then it must have been approved by the board or management at the management meeting. So we obtain and review the board or management minutes, depending on which authority we want to rely on, to review whether there was a discussion about acquisition of PPEs. Number one. Number two, how was the PPE to be financed? Because if management told us that, oh, we bought PPE during the year, but in the board minutes, it was discussed, but the deal was the entity will lease the asset, then there is some level of inconsistency there. So who is lying? The board minute is saying that, yes, we will, the company will acquire assets, but they are going to lease it, not outright purchase. But management is telling us that, hey, the increase in the PPE, we outrightly bought the assets. So there is inconsistency here. Now we need to dig further, because what is in the board minute is different from what management is telling us. Who do we trust? So we need to dig deeper and inquire, where are the supporting documents? If you outrightly bought it, okay, where was the purchase order, the invoice you got from the supplier? We need it. Where is the bank account? We check. When did you make the payment to the supplier? We need that. So you realize that reviewing the board minutes and then the management minute is just an extra layer of work we are doing to test assertions such as occurrence. Because if something has happened, then it should have been approved by the management or discussed at the management level. Or there is a lawsuit pending. So at the end of the year, like the question we looked at under Omega, the lawsuit, at the end of the year, management has not made any provision for it. Okay. So it means there is a discussion about that in the board minutes. What has management said in the board minute in respect of the outcome of the case? So they might not have made any provision for it, but maybe in the board minute, they have discussed it that it's possible the entity has to pay some money. So if management has discussed it and it's in the board minute that it is likely we're going to pay some money, why didn't you make provision for it? So again, there you see that we're going to smell inconsistency between what is in the financial statement and what is in the board minutes. So as auditors, we are going to be interested in these other documents, review these other documents, not because we will express an opinion on them, no, but it is because we want to find out about consistency in the application of various accounting principles, as well as the disclosures made in the notes to the financial statement, and giving us further information to corroborate the evidence that we have obtained, either directly from management or through our other review works. So that is why we are reviewing some of these other documents. So yes, primarily our gaze is on the financial statement, but that does not mean that is the only thing we are looking at. We are going to be looking at board minutes, management minutes. We're going to be interested in looking at director's report, sustainability report that the company is going to be looking at. We want to look at all of those things because that could give us some ideas about certain things presented or done in the financial statement. We're going to go through an audit report in a moment, or two audit reports as we mentioned in the previous session, and you're going to see how these feed into the main audit report in our discussion as we proceed here. So that's the first thing. Any questions, you raise your hand, we'll bring you up, or you put it in the chat for me. But not only that, when we get to the review stage like this, it is important, in addition to subsequent events, reviewing of other documents, it is important we also assess the going concern status of the entity. Now, stay with me carefully here. Going concern simply is assessing whether the entity can continue and be in business in the next 12 months. That's all. Yeah, in KG2, you learn that going concern means the entity can operate into the foreseeable future. It is just 12 months. Okay, so can the entity be in operation in the next 12 months? So when it comes to going concern, it is important we ask ourselves, what is the role of management? What is the role of auditors when it comes to going concern? And I need you to stay with me carefully here. What are the roles of management? What are the roles of auditors when it comes to going concern? Simple. As always, it is management responsibility primarily to assess the going concern status of the entity. So management has the responsibility to assess the going concern status of the entity. All right? That's management's responsibility. In so doing, management is going to be looking at various indicators in assessing their going concern. For instance, they're going to be looking at their finances. Do they owe some loans that are due to be repaid within the next 12 months? And do they have the money to be able to repay the loan? Are there any significant secured debts that are due for repayment or redemption? Does the entity have the money for it? Because remember, if it is a secure debt and it is becoming due, but the entity doesn't have money for it, then the bondholder or the creditor or the bank is likely to come and take over the asset that the entity used as a collateral facility. So the financial needs of the entity will be looked at as an indicator. If it is a financial institution, then we are going to be dealing with the issue in respect of capital adequacy ratio and all of those things. And we'll get into some of these in a moment as we continue in our discussion. Because the 2024 financial statement of Carl Bank, the auditors of Carl Bank brought uncertainty about going concern in the report because they were doubting Carl Bank's ability to continue as a going concern due to the various indicators that they were having, which were really poor. And so you realize that late last year, Cal Bank did a right issue and then recapitalized to bring itself back at the end of the day. So when assessing going concern, these are the issues, the financial requirements. But we are not just going to be looking at the financial requirement. We are going to also be looking at the operational needs of the entity. The inputs that we need, the raw materials we need to produce, do we have it? Do we have customers? Have we lost any significant customer? That is going to be considered as well. Then it's important we talk about the legal and issues about competition. Legal in the sense that, again, let's say we are highly regulated or we are in a highly regulated industry. Then, like a bank, right? Minimum capital has been increased, or insurance, minimum capital has been increased. Can we meet the minimum capital requirement? If no, then probably we need to fold because we cannot continue as a going concern. Or there are significant lawsuits against us, which when we lose could result into the revocation of our license. Or maybe the competition is tough and we don't have a significant market share as an entity. So that could affect our ability to continue as a going concern. That is another thing there, the legal competitive environment that must be considered. Then the entity itself, we have to look inward within the entity, issues on governance. Okay, corporate governance issues. If during the year the entity lost some significant key management personnel and the entity has not been able to replace them, that may be an indication that we are heading south. Okay? Or if the entity doesn't have effective and efficient internal controls and that has resulted into producing low quality products, affecting the brand of the entity, then that could affect us. So corporate governance issues, all of these could be considered. And so primarily, it is management's responsibility to assess the ability of the entity to continue as a going concern. Based on that assessment, management is then going to prepare the financial statement on a going concern basis. Because for the most part, unless otherwise the worst scenario or circumstances, management is going to say, oh, we're going to operate into the foreseeable future. So they're not going to fold. You get the idea? So primarily, that is the job of management. Okay. But when we come as auditors, what do? Because remember, we have to also be able to look at what management has done. So our role as auditors will be divided broadly into two main categories. And I need you to stay with me here carefully. Two main categories. The first category here is to assess the reliability of the going concern assumptions by management. Okay? So assessment of the reliability of the going concern assumptions by management. What does that mean? Let me give you an example. So we came and we saw a number of things. So permit me, let me put something up here for us. So indicators of going concern. And then mitigating factors. Or if you want actions, stay with me. So we came. And then one of the things we saw was the entity lost of key customer. So during the year, a customer that buys significant portion of the entity's production has found another supplier from whom they will be buying. Okay. Now, this customer is buying maybe 40% of the entity's production. The entity has lost the customer. Or maybe the customer is a government. And so now that there is a change in government, new sheriff in town, we've lost that contract. As auditors, we have to sit down with management and ask them, hey, is the loss of this customer going to affect the going concern of the entity? What measures has the entity put in place to make up, if not for all, part of the sales that will no longer be made from this customer? So this is a red flag for us. Potential going concern issues. After the discussion with management says, oh, take a breeze. The Ghana government has ignored us, but don't worry. We just signed a new contract with the South Africa government, with the Rwandan government, with the Nigerian government. Ooh. So that is the mitigating factor. So although there is a loss of key customer, boom, the entity has identified an alternative customer or market to go and sell their product. Are you following the issue? Now, stay with me. You asked management about a customer they have lost. Then they said, take a breeze. We have identified a new customer. Or there is a new market we're going to sell our product. So don't worry, because the customer we have lost, it won't affect our going concern. Hold it. We now have to assess whether management is telling us the truth or lying about the new customer. That is why we said as auditors, we are assessing the reliability, the reasonableness of the going concern assumptions by management. Because management saw this issue, 40% customer gone, and they have put in place a mitigating factor. So now we will say, hey, which customers? Like I said, we've signed a contract with the South African government. We've signed a contract with the Nigerian government. Okay. Can we see the contract? Let's go and speak with the agency or the country or the company that you claim you have had as a new customer. What are we trying to do? We are corroborating what management is telling us. If from our further investigation we realize that, it's true, although the entity has lost its current customer, they have identified a new customer, or they are now going to be selling their products in a new market. Come on now. Then everything is good. So the lost customer is no longer a problem. Are you getting the idea here? Because the mere fact that there is an indication does not mean the company is going to sink. That's the idea. Or number two, like I mentioned earlier, there is a financial challenges facing the company. Maybe it could be a capital adequacy issue. Okay? Issue. Or maybe loans repayment issue. So the company has some loans that they are supposed to repay. But when we look at the cash and cash equivalent and the loans that are due for repayment, Charlie, there's no money. Then we asked management. The management said, don't worry. As auditors, we serve a true living God. The living God we serve is going to help us, and we are going to do issue of new shares. Or oh, don't worry, we are renegotiating the loan repayment. Or don't worry, we are even going to we are even going to bring in a new loan, okay, to pay. So hold it. You have financial challenges. Per that, it's not possible to continue as a going concern. But management is saying, auditor, take it easy. You don't know. You don't know the God we serve. You don't know the world we are in. We're going to issue new shares. Okay? So we as auditors are going to sit down. Hey, can this company issue shares? If yes, how much are they going to get from the issue of shares? Okay. How can that help solve the financial issues? We have to assess that as auditors. Or they said, oh, the loan, don't worry, we are renegotiating the payment terms with the bank. So what do? We would then inquire from the bank whether there is a renegotiation of the loan repayment. If there is a renegotiation, we need to confirm from the bank whether they are likely to accept extension of the terms or any renegotiation currently going on. If the bank gives us an assurance that, oh, this is our client, yes, they are in deep trouble, but we wouldn't allow them to sink. For that reason, we are going to support the renegotiation and recapitalization and ensure that they bounce back, then no problemo. Or the company says, hey, guess what? We are in financial difficulty, but we're going to issue some loan notes and even get more money. Is it possible? Can they do it? Will they get the money? We will assess that. So based on the results we get from the procedures we undertake by reviewing the actions management said they are taking or they have taken, you will realize that, oh, it's no longer an issue. We think that this is right. It's a step in the right direction, and so our opinion will not be influenced. I hope by now you are getting the idea about where I'm going with the whole discussion on going concern and what we do as auditors. So it could be anything at all that raises our concern as auditors, which has a potential of affecting the going concern status of the entity. What we do as auditors is to ask management, hey, Coco, what have you guys done about this issue? Do you know it has a potential to affect your going concern? The management says, no problemo, auditor. We've done A, B, C, D. Then as auditors, we would have to review what management has done and assess whether what management is saying is reasonable, is acceptable. That's the first thing we do as auditors, assessing the reliability of the going concern assumptions by management. But you see, if you remember from the audit procedures, one of our audit procedures is recalculation and reperformance. Reperformance means we redo what management has done. So when it comes to going concern also, the auditor has to independently assess the going concern status of the entity. So in addition to reviewing what management has said about their going concern status, we have to also carry out various procedures in assessing the going concern of the entity. So the auditor will perform various procedures in assessing the going concern status of the entity. Sounds good? That's what we do as auditors. So what does it mean? we look at the overall organization, what the assumptions management have made about the going concern in the organization or for the organization, then we assess their reasonableness, and then we perform our own procedures. So at the end of the day, this is the problem. This is the solution to management. Does it make sense? Can it help the company? And so quite a number of things will be happening at that performance stage. Sometimes it's all about procedures. So inquiry from management, and then analyzing subsequent events. Okay? So some inquiry from management, and then certainly reviewing subsequent events. Because subsequent events may have ISA 560, what we discussed in the previous session, may have various effects on the ability of the entity to continue as a going concern. So as auditors, we're going to be asking management, hey, how do you identify subsequent event? How do you deal with a subsequent event? Are they adjustable? Are they adjusting events or non-adjusting event? If they are adjusting event, have you adjusted a financial statement? If they are non-adjusting event, have you disclosed them in the notes because they may be material? That is what we need to understand when it comes to going concern. So what's the key takeaway? The examiner may give us a question, and then there may be some stories built up in the question. Based on the stories built up in the question, the examiner may ask us what are some of the issues that may bring uncertainty about going concern of the entity. On the background of that, we're going to be writing out various points. Then the examiner may ask you, if management refuses to do the right thing, what opinion or how would this influence our audit opinion? And we'll come to a question like that in a moment, just stay with me. But that is what you must understand when it comes to going concern. So again, we are at the final stage of our audit. But before we come to the audit report, we need to look at subsequent events. We need to review some other documents. We need to assess the going concern status. All of these are part of our procedures we're going to be doing before we come to the final part of our discussion, which is going to be the audit report. So if everything checks out, then we come to the lion's share here. That is the audit report. This is why we have been working, is to issue an audit report. Please stay with me. You will not be required to prepare an audit report. However, you may be asked to critically appraise an extract of audit report. And this is where everything comes together. The examiner will not ask you to prepare an audit report, but the examiner may ask you to critically appraise or assess an extracted audit report. So let's put it together then. When it comes to the audit report, we have generally two types of audit reports. We have what is referred to as a modified audit report and then unmodified audit report. Stay with me. The reason we have these two broad audit reports is because of the opinion that we are going to be expressing. In an unmodified audit report, here the auditor issues an unqualified opinion. The auditor issues an unqualified opinion. What is an unqualified opinion? Unqualified opinion is where the auditor says, oh, The financial statement taken as a whole represents the true and fair view of the entity. So everything is okay. Literally. Everything is okay. That is an unqualified audit report. Please stay with me. So when the auditor says, boom, everything is okay, that's all. An unqualified audit report. So the financial statement taken as a whole represents the true and fair view of the entity, an unqualified audit report. Then we come to a modified audit report. In a modified audit report, this is where the auditor is modifying his opinion. And so in a modified audit report, there are 3 types of opinion that can be issued based on 3 key factors. And we'll come to that in a moment. So 1, the auditor can issue what is referred to as a qualified report, a qualified opinion, which is also referred to as an except for opinion. This is the kind of opinion that the auditor says, oh, the financial statement taken as a whole represents the true and fair view of the entity with the exception of. Again, you're going to see this play out in a moment, so don't worry, just stay with me. Because everything we are doing, as I keep on telling you in auditing, we are not just chewing some baba and walking away. So you're going to see all of these at play in a moment. Just bear with me to understand the principles. So the financial statement taken as a whole represents the true and fair view of the entity, except something. Something. So it means that there is something that the auditor and the management did not reach reasonable understanding. So the auditor said, oh, I can't say everything is okay. Everything is okay, but this one. That is a qualify or an accept for opinion. But the auditor can also issue what is called a diverse or adverse opinion. This is where the auditor said, Mbano, the financial statement taken as a whole does not represent the true and fair view of the entity. In other words, the auditor is saying that everything is smelling. Okay? Everything is bad. So maybe misapplication of accounting principles, significant material misstatement in the financial statement. So auditor concludes and say, based on what is happening, I don't think I can say everything is okay. So everything is bad. Adverse or diverse opinion. The third one is my favorite, and it is called the disclaimer opinion. Disclaimer opinion. This is where the auditor says, I cannot express an opinion on the financial statement. What the heck? You have done your job. You started planning. You did your procedures. You asked us questions. You finished your work. And you are saying you cannot express an opinion on the financial statement? Yeah, that is the disclaimer opinion. Here, the auditor says, I cannot express an opinion. Now, here is the question we want to ask ourselves. Why would the auditor get to this level? Why will an auditor, after all the job we've done, say that I can't express an opinion? So let's look at some of the reasons, probably possible reasons. Any ideas? Why do you think the auditor may issue this? Any ideas? Think about it and give me some apport. So reasons why a disclaimer opinion may be issued. Why will or may this happen? After carrying out our procedures as auditors, now we are saying we cannot express an opinion on the financial statement. Why could this thing happen? Certainly, all this will happen because there is disagreement between management and the auditors. Okay? There's a disagreement between management and the auditors. That is why we are seeing this. But what will be that? Number one, it could mean that, management refuses to furnish auditors the necessary information required for the audit. Sounds good? That's the first thing we can say. Remember, we said in the pre-acceptance procedures, according to ISA 210, agreeing the terms of an audit engagement, the third one that we said was that management acknowledges that they will provide us with what? Information that we need for our audit. So now we have come, we are doing the audit, but management is refusing. We have come, we've seen that there is a significant financial challenges about the entity. And we're asking management, hey, what are you guys doing about this? There are various mismatch in the recognition of the revenue of the entity, looking at the guiding principles on IFRS 15, and then the conceptual framework on how assets, liabilities, and everything is supposed to be done. Management is doing contrary. And we asked management, why? And management said, get the heck out of this place. Okay, we're going, but we're going with a disclaimer opinion. So management doesn't want to furnish us. Number two, sometimes management prohibits or limits auditors' access to key part of its internal controls to undertake the audit and use secrecy as the reason for that. So management limits access to or prohibits the auditor from assessing certain documents and or internal controls. Sounds good? And or internal controls. That is the second thing that we can talk about in respect of why we could come out with this. Please give me a sec. Okay? Why we can come out with this. So management is like, hey, so we come and we want to attend the inventory count. And we attended the inventory count. But when we ask questions about why some inventories were not counted, or why they counted some inventories in a certain way, or why some inventories are sealed, they said, hey, you can't touch this. Hey, you can't go here. No, this part of our system, you can't see it. It's business secret, trade secret. We can't let you have access to it. Hey, could it be that management is la? doing something shady, something illegal? Because if that thing is significant part of our audit, then refusing access means we are not able to gather evidence, so we may issue a disclaimer opinion. So primarily, the disclaimer opinion is coming in because we are unable to issue sufficient appropriate audit evidence. That's all that is happening here. That's all. But here is the deal. When can the auditor issue a qualified opinion? When can the auditor issue an adverse opinion? When can the auditor issue a disclaimer opinion? I have given you the generic reasons for it and what they mean, but there are three factors that will determine the suitability of either of these three opinions in a specific scenario. So let's look at the key factors here. The first one is the materiality of the subject matter. So the materiality of the subject matter. The second one is the pervasiveness of the subject matter. Now, pervasiveness simply means the impact that the subject matter has on the financial statement. Stay with me carefully. So, when a subject matter issue is pervasive, it means that it has significant impact on the financial statement. But when we say a subject matter is not pervasive, that means that it doesn't have significant impact on the financial statement. Are you getting the story? That is what we mean by pervasiveness. The third one is the ability of the auditor to obtain sufficient appropriate audit evidence. So the ability of the auditor to obtain sufficient appropriate audit evidence. Audit evidence. My pencil is misbehaving a little bit. I don't know why. Okay, let's go. So these are the three key factors. So if we have a given scenario, should we issue a qualify for, a diverse, or disclaimer opinion? To answer that question, we must then ask ourselves, is the subject matter material? Now, here is the takeaway. I got to bring up my slide again. Give me a sec. Let's see if I can bring up my slide. I'm hoping that it will open in the existing file. Yeah, it does. Thanks be to God. So I want to show you something in the book real quick. There's a simple diagram that I want to bring up. Permit me to bring it. This is it. On page 250 of the book, I want to bring this diagram up. So here is the piece. If the auditor is able to obtain evidence and the subject matter is material but not pervasive, it means that, yes, it is material, but it doesn't affect the whole financial statement. In that case, the auditor can issue an except for opinion, a qualified opinion. So we've been able to obtain sufficient appropriate audit evidence, but the subject matter is material, however, it's not pervasive. In other words, it doesn't render the whole financial statement useless. then we issue an except for. That is why we will say that, oh, the financial statement taken as a whole represents the true and fair view of the entity, except this one thing that is material, which management did not do well. Number two, if the subject matter is material and also pervasive, meaning it has significant impact on the financial statement taken as a whole, guess what? It means the financial statement is smelling. For that reason, we issue an adverse opinion. So the subject matter is material, it is pervasive, so we issue what? An adverse opinion. Finally, the subject matter is material, it is pervasive, and the auditor is unable to gather sufficient appropriate audit evidence. Then in that case, the auditor has nothing but than to say, I cannot express an opinion on the audit report, and that is a disclaimer opinion. So these are the three things that determines the appropriateness of audit opinion to be issued in the modified audit report. So together, there are four types of opinion. Unqualified opinion, BBI fine. Everything is okay. All is well. Qualified opinion, everything is okay except for something. Diverse opinion, nothing is good in this financial statement. Disclaimer opinion, we cannot express an opinion on the financial statement. So in each audit report, one of these guys will be there. It is either we are saying BBI fine, unmodified, or BBI fine, name mum, except for opinion. So let's look at a question and see how this plays out in a given scenario. So we go to our question kit, and then we want to look at this question. Give me a sec. Let me see which question kit that is. That is the second question kit, page 34. Page 34. The second question kit, the one that you did, I gave the audit report assignment, audit risk assignment in page 34. Here we go. Page 34, audit reporting. Please stay with me carefully. Now we want to see how what we just discussed may be asked by the examiner. And that's my goal here as always. We are learning something. We need to understand what we are learning. But after we understand what we are learning, it is important that we know the way the examiner is going to get goosebumps and ask the questions, and most importantly, how we are expected to provide answer to the questions. So let's look at this question, Zillow Company or Zillow Company. So Zillow Company. What is the requirement? Let's see. For each of the items, recommend the type of audit opinion to be issued. For each of the items, recommend the type of opinion to be issued. Okay, let's go. Then the II says, we'll come to the II, don't worry. Upon the completion of the audit of Zillow Company Limited, the engagement partner reviewed the audit working papers and came across the following. 1. There was material inconsistency between financial information and other information in the documents containing the financial statement and the auditor's report thereon. The material inconsistency has been traced to the financial information, but management has refused to reflect any change when requested to do so. Please, so get an understanding of what's happening here. There is material inconsistency. So what it means is that, back to the principles, the subject matter is material. So we've checked the first box. We are told that the inconsistency has been traced to the financial information, but management has refused to effect any change when advised to do so. So it's likely to be pervasive. The auditor has gathered evidence about the subject matter. The question is, which opinion should we issue in this case? An except for opinion? An adverse opinion? Or what? Now, this is the beauty of this particular story we are building here. Yes, the subject matter is material because we are told it is material inconsistency. But then we are told also that, it is traced to the financial statement. But that doesn't tell us whether it will have the impact it will have on the whole financial statement. So on the level of pervasiveness, we are not too clear. So in this case, we are going to be writing conditional answer. What do I mean by that? It means that we will say that if the material inconsistency is not pervasive, then since management has refused to effect changes, we will issue an except for opinion. But if the material inconsistency is deemed to be pervasive, then we will issue an adverse opinion. Did you get the story? So that's going to be the answer we're going to be writing here. So material inconsistency. The appropriateness. So I'm just going to build a little story for us. The appropriateness of the opinion of the audit opinion depends on. Now, I'm not going to be writing again, okay? Because at this point, we know how to write things down. The appropriateness, let me say appropriately. The appropriateness of the audit opinion depends on the materiality and pervasiveness of the material inconsistency. Of the material inconsistency. So, as we said, if it is not pervasive, an except for opinion okay, will be appropriate. However, I don't know why. I think I need to change my writing part because my pencil is misbehaving. I don't get it. However, if it is both material and pervasive, a diverse opinion. See, I told you that disclaimer is my favorite. A diverse opinion should be issued. Okay? Should be issued. And please, let me say this. We will be writing our answers from the third person singular perspective, okay? There is nothing like, oh, I will, you should, we should. No, we don't do that. Okay? We don't do that. So even if the question is personified, that what will you do or what should you do if you are the auditor, you don't say, I will. You get the idea? Your answer must always be written from the third person singular. So no I, no you, the third person. That's why we always go with the auditor should, the auditor can, he or she should. So we are coming in from the third person singular. So be mindful of that. No first person or second person. So that's our story for the first one. Material inconsistency. So we can't just say we will issue one type of opinion here in respect of that. Forgive me, except doesn't have R here. Okay? So if it is not pervasive, except for opinion will be good. But if it is pervasive, then a diverse opinion will be appropriate. That's the story there. You see that it's not difficult, cry. Again, if you understand the principles. Let's go. Second story. Stocks worth 5 million Ghana cedis were valued at cost in the financial statement. Hold up. Remember, I keep on telling you that as auditors, we are also interested in the financial statement itself. And so they have valued inventory at cost in the financial statement. The reason I paused on that is because, in accordance with IAS 2, inventory should be valued at lower of cost and net realizable value. So let's continue to build the story. The review of the post-balance sheet event indicated that not all the stocks could be sold in the normal course of business. Some were damaged and some become obsolete and slow-moving. The total asset of the company is 20 million. If the stock were valued at net realizable value, the value would have reduced to 2 million Ghana cedis. Okay. The directors have refused to allow the stock to be valued at lower of cost and net realizable value and value all stocks at cost. What is that? That is contrary to IAS 2. Management has refused to value the inventories at lower of cost and net realizable value. So what have they done? We are told that they are carrying the inventory at 5 million. But if we had used lower of cost and net realizable value, that figure would have reduced by 2 million. So it means they have overstated closing inventory by 2 million. Right? So what is the materiality of the closing inventory? You were given total assets of the entity to be 20 million. So 2 million over 20 million times 100, that's going to be 10%. Is that material? Yes, it is. So the overstatement of inventory, closing inventory by 2 million is material. Now, management has refused to do the adjustment and continue to carry the inventory at cost. So is that pervasive? No, because overstating inventory alone doesn't render the entire financial statement useless. Doesn't make the whole financial statement wrong. Yes, that error will affect profit for the year, the current assets, the total asset figure, the retained earnings figure, but it doesn't render the whole financial statement useless. For that reason, yes, it is material. The overstatement of inventory is material, but not pervasive. So what we're going to do? A qualified opinion will be appropriate here. You see the idea? So, overstatement of closing inventory. Overstatement of closing inventories. So, the overstatement is material to the statement of financial position. It's material to the statement of financial position. Okay. As it represents 10% of the total assets. %10 of the total asset. As such, a qualified opinion or an acceptable opinion should be issued. Okay, as this may not be pervasive. Okay, again, you paying attention to the structuring of the write-up, right? As we say all the time, the structuring of the write-up, the way you are writing out the answers. It's very simple, but you need to be able to communicate your thoughts right. So that's the second idea, qualified opinion. So again, you see that in this question, you are given total assets. If you remember from the audit procedures, we said when we have total assets and profit for the year or total revenue, it means the examiner wants you to calculate the materiality of the item in the question. But again, you have to be careful here because we are not calculating the materiality using the whole 5 million. We are calculating the materiality using the error that has been committed. And that is another thing about materiality that you have to be mindful of so you don't screw it up. Because somebody would have just taken the 5 million, which is the cost of the inventory, over 20 million and do the materiality. Yes, you will get 40%. Your answer is still material. Sorry, that will be 25%. Your answer will be material. But the percentage is wrong, which renders your answer significantly wrong. So it is the error that has been committed. They have overstated it by 2 million because if they had done the right thing, it would have been reduced by 2 million. So the overstatement is 2 million. So it is that 2 million, that's the error. So what is the materiality of that error? That is what we will be thinking about. Very important. Okay? Very important. 3. Management refused to allow auditors to carry out secularization of debtors. If you remember when we were in audit procedures, we said one of the key procedures we carry out as auditors is secularization, sending out circulars to the debtors. You can't say you have audited debtors without sending out circulars. So it is a crucial procedure when auditing debtors. Here we are, management is saying, Mba. So they are hindering our ability to gather evidence. Let's read on. The receivable figure was material in the financial statement, so it is material. In addition, the auditors have not received a reply of the letter of inquiry sent to the company's solicitors in respect of major litigation affecting the company. Okay. The auditors assess that the effect of these two is both material and pervasive. Do we need any miracle? No, we don't. Because the last sentence, that the auditors assess that the effect of the two items is both material and pervasive. If it is material and pervasive, what do? Disclaimer opinion. Because they've hindered our progress, we cannot gather evidence, so here we'll issue disclaimer opinion. Make sense? That will be the opinion we will issue. So I won't write a lengthy answer for this, but we'll issue a disclaimer opinion. Again, paying attention to the way the concept is to be applied based on the principles. Based on the principles. Very important. Very important. Finally, the last one. Subsequent events indicated that a major debtor has become insolvent. Ooh. A major debtor has become insolvent. The amount involved was material. The directors refused to recognize the provision for a write-off of the amount. Okay. So this is just a debtor's balance. Somebody is owing the company, a major debtor, and has become insolvent, bankruptcy. And the amount is material. But management said, we ain't writing that off. We ain't making any provision for bad debt. Now, not making provision for bad debt is not something that will render the whole financial statement useless. So it is material, but not pervasive. Hence, we will issue a qualified opinion. Sounds good? That is what we mean by audit opinion. Any questions? That's all you need to understand here. So it's a styling of question that the examiner can present to us in the exam hall, where he's asking us, hey, looking at what you have here, can you tell me what we are supposed to do? What opinion are you going to be expressing as an auditor? That's it. We're done. And so we go back here. The audit report, modified or modified. Under the unmodified, 3 factors. Have we been able to gather sufficient appropriate audit evidence? That's the starting point. 2, is it material? Is it pervasive? Does it affect the entire financial statement? These are the things that we must understand when we talk about the audit report and the opinion to be expressed in the audit report. Now, let's take it a step further. The actual opinion in the audit report is just one part of the audit report. So let's look in detail the pro forma of the audit report. Okay, so you can take a screenshot of this. Zillow. So what is the pro forma of the audit report? Because again, we are not going to be preparing audit report, but we must know the format of the audit report. Then from there, we take a styling of practical audit report and see how they are going to be done. But certainly, we're going to take a short breather. Then we come back and go into the second phase of our discussion on auditing today. Okay, let's go. 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 Go, 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 go. Let's go. So now let's look at a pro forma of the audit report. The pro forma of the audit report. Let me repeat. We will not be required to prepare audit report in the exam hall. However, we may be given a question that will require us to critically appraise the audit report. And so knowing the pro forma of the audit report is crucial. Now, I'm going to use two companies' audited financial statement, MTN Ghana and Scancom PLC and SIC PLC 2024 audited financial statement to bring home my discussion on the audit report. Okay, because I want you to see practically what we are doing and how it is reflected in various audit reports. So the first thing about the audit report pro forma is the title. So you're going to see independent audit report. The second most important thing is the address. The audit report is always addressed to the shareholders of the company. So if we have an extract audit report and they address it in the audit report to shareholders and management of Nkunku Limited, then there is a problem there. Because the audit report is addressed solely to the shareholders. So title, independent audit report, address to the shareholders of the company. So let's see practically what we have here. So this is SIC Insurance PLC. Their auditors is Baketili. If I don't mention the name right, please forgive me, okay? Baketili. They are the auditors of SIC Insurance PLC. And this is their audit report for the 2024 financial year. So look at the title, Independent Audit Report. Then the address to the shareholders of SIC Insurance. Let's come to Scancom PLC or MTN Ghana. For the 2024 financial statement of MTN, it was audited by EY, Ernst or Ernst and Young, depending on how you want to pronounce it. Again, title, Independent Auditors Report to the shareholders of Scancom PLC. So you see, in the case of EY here for MTN or Baketali for SIC Insurance, the same idea. Title, address. After the title and address in the pro forma, we come to the first main paragraph of the audit report, and that is the opinion paragraph. Stay with me. In the opinion paragraph, there are certain things that must be there. Please, we will not be asked to prepare an audit report, but the examiner may ask us to critically appraise an extract audit report. That is why we are doing this. So you must know what is coming in each paragraph well when you are going to critically appraise an extract audit report. So in the opinion paragraph, what do we see? One, the auditor must mention the financial statements audited. Okay? The auditor must mention the financial statements audited. So which financial statement did we audit? It must be listed there. That's the first thing in the opinion paragraph. Second, the auditor must state explicitly their opinion. Qualified, unqualified, except disclaimer, explicitly. 3, the auditor must also mention the regulatory requirements. That is, how the financial statements were prepared, IFRSs, and other acts and regulations. So in the opinion paragraph, we expect to see a list of the financial statements audited, the opinion of the auditor, and an express statement on whether the financial statements were prepared in accordance with IFRSs and other acts or regulations relating to the industry within which the entity is operating. So that is the opinion paragraph. Now let's come to Baketili audit report on SIC Insurance PLC. Straight up, what do you see? Qualified opinion. So for the 2024 SIC Insurance PLC, the auditors, Baketili, issued a qualified opinion. You know a qualified opinion already. So look at it. We're going to read a little bit so you get the understanding. We have audited the consolidated and separate financial statement of SIC PLC and its subsidiaries for the year ended We audited the income statement, statement of cash flow, yada, 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 and all of those things. In our opinion, so again, back to pro forma, list of the audit financial statement audited. Second, the opinion. Back here. So after they listed the financial statement, then they said, in our opinion, except for the possible effect of the matter disclosed in the basis of opinion paragraph, all the accompanying consolidated financial statement present fairly in all material respects of the company in accordance with the IFRSs, okay, the Companies Act, and then the Insurance Act. Did you see that? So thematically, in the opinion paragraph, we are seeing the list of the financial statements. We are seeing the audit opinion, and we are also seeing the IFRS being mentioned and then the acts, because we have to state that, oh, the financial statements are in accordance with IFRS accounting standards issued by the ICAG, the Companies Act, and Insurance Act. Opinion paragraph. Let's come to Ernst & Young's auditor's report on Scancom PLC. So here you are seeing opinion. So let's read. We have audited a separate financial statement. So they listed the financial statement they've audited. In our opinion, the accompanying consolidated gives a true and fair view of the financial position of the entity. This is an unqualified opinion. It means BBI. In the case of SIC, it was an except for opinion. You get a difference of what's happening here? Then, again, it says, oh, the financial statements are prepared in accordance with IFRS accounting standards issued by the International Accounting Standard Board, and then ICAG, then the Companies Act. I hope you are seeing the similarities, right? That is what we mean by pro forma. So that's the second item there, opinion paragraph. and the individual things that must be there. So when we pick an audit report and we are evaluating it, the opinion paragraph should capture these things. So if any of these things are not listed or is not listed in the opinion paragraph, then we will conclude that the opinion paragraph is incomplete. Or if they include something, sorry, that should be included in a different paragraph, then we will say, no, the opinion paragraph is not appropriately presented. From the opinion paragraph, we come to the next paragraph called basis of opinion paragraph. This is where the auditor explains how they arrived at their opinion. So the basis of opinion paragraph. Again, in this paragraph, thematically, there must be a number of things. 1, the auditor must make reference to the ICAG Code of Conduct. You remember ICAG? Ethics. Because remember, as auditors, we must be independent. So explicitly, clearly, in the audit report, the auditor must state that, their job was done independently in accordance with what? The International Ethics Standard Board of Accountants Code of Ethics. Clearly, ICAG must be mentioned. 2, how they conducted the audit in accordance with ICAG. So we are independent of the client in accordance with what? The ICAG Code of Ethics. And then we carry out our audit in accordance with what? The ICAG, International Standards on Auditing. So in the basis of opinion, among other things, these are the things we want to see. Let's go to Ernst & Young and Baccatelli & C. So basis of opinion for Scancom PLC, issued by EY. It says, we have conducted our audit in accordance with International Standards on Auditing. Did you see that? Reference to ICAG. Our responsibilities under those standards are further described in the responsibility paragraph. Then he says, we are independent of the group and the company in accordance with the International Ethics Standard Board of Accountants. We believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. So that is the basis of opinion paragraph. Let's look at Baccatelli for SIC Insurance. Remember, they issued a qualified opinion. So basis of qualified opinion. So now they're going to give reasons why they reached that conclusion. And it was about a subsidiary which was not properly accounted for. Okay? As against, they were applying IAS 20, treating it as a subsidiary, but the auditors disagreed with the treatment. So they gave a reason for that. But he says, we have conducted our audit in accordance with the ICAG. We are independent of the group in accordance with ethical, ICAG Code of Conduct. We believe that the audit evidence we have obtained is sufficient to provide a basis for qualified opinion. So it's more or less like there is a pro forma, there is a draft. So when you finish the audit, you come and then do what you have to do, because you are seeing the similarities, right, in the way the write-ups are going, with the exception of the various issues that they are modifying. That is the idea about the second main paragraph, or the basis of opinion paragraph. So you're seeing consistency. So now if the examiner gives you a 10 or 15 marks question that, hey, analyze, evaluate, critically appraise this extract audit report for 10 marks or 15 marks, you know what you're supposed to do. Now, The next paragraph is called key audit matter. But here is the deal. Between the basis of opinion paragraph and the key audit matter paragraph, there could be another paragraph referred to as material uncertainty relating to going concern. So this is where the auditor is doubting whether the firm or the entity, the client, can continue as a going concern. So give me a moment. Let me see if I can bring Carl Bank's audit report up. I have it here. Just give me a sec. Let me see if I can bring it up to show you how that is also presented. I thought I had brought it in my slide already, but I didn't. So give me a sec. Let me see if I can quickly see it here. If not, then maybe next week we can look at it. But I'm hoping that I'll be able to just see it. Carl Bank. No, this is Echo Bank. Hold me up. Please give me a sec. Who is this? Kenoforia? No. Prudential Bank. Unibank Limited. No, I don't need that. Oh, we are seeing who? Yeah, I found the Carl Bank. I've seen the Carl Bank. It's coming up, loading. So, because I want to show you Carl Bank's 2024 financial statement, because their auditors issue an unqualified opinion, though, but then they brought in the paragraph relating to going concern uncertainties. So, Carl Bank 2024 report. I want us to go straight up to the auditor's report, page 60. So let's go to page 60. Okay, 60 is around here. Oh, okay. More or less like my slide want me to scroll. Carl Bank. So Deloitte. Again, so in our presentation here, you are seeing Bakatelli. You are seeing Ernst & Young or Ernst & Young. And then you now see Deloitte. But I want you to see the consistency, then the pro forma as we are building up the story. So again, this is Deloitte, Carl Bank audited financial statement, or Carl Bank's audit report for 2024. So look at the title, Independent Auditors Report to whom? The shareholders of Carl Bank PLC. The opinion paragraph, they have the same idea, listing the financial statements that they audited, right here. Then making reference to the International Accounting Standards, and then the Act. So here we are dealing with Companies Act, and then because it is a bank, we have to mention, or they had to mention, the Bank and Specialized Deposit Taking Institution Act 2016, Act 930. But you are seeing in either report, the format is the format, the rule is the rule. Then we come to the basis of opinion paragraph. So this is what I wanted to show you. So now you see that in the Carl Bank Deloitte report, after the basis of opinion paragraph, you are seeing material uncertainty relating to going concern. That is what I'm explaining to you in the pro forma guideline. That in between the basis of opinion paragraph and the key audit matter paragraph is material uncertainty relating to going concern. Now, this paragraph will only be included in the audit report where the auditor is in doubt as to the ability of the entity to continue as a going concern. So you realize that when, my slide has gone again. Give me a moment. Let me see if I can bring it up back. Opening an existing file for me, okay? Thanks. So you realize that in Bakatelli, from the basis of opinion paragraph, they go straight to the key audit matters. Because Bakatelli did not raise any going concern issues about SIC. If we come to EY in the MTN environment, they moved straight up from the basis of opinion to the key audit matters. Why? Because EY did not doubt the ability of MTN or Scancom PLC, the group, to continue as a going concern. But when it got to Carl Bank, Kambeka Data Bank, you see who? When it got to Carl Bank, Deloitte said, hey, Carl Bank, we think you cannot continue as a going concern, or we are in doubts that you can really be in business in the next 12 months. So give me a sec as it loads quickly. So you see what we are doing and how it's represented practically. And that's the beauty of auditing. So what we are doing is not just like, oh, when I finish, when you see it, and no, you're going to see what we're doing in practice. So if we come to Deloitte's on Carl Bank PLC, you see that between the basis of opinion paragraph and the key audit matter paragraph, we see the material uncertainty relating to going concern. Now let's read it quickly so that you understand what is reported there. It says, we draw the attention to note 42 of the financial statement, which indicates that the bank and the group reported a net profit of this. In 2023, they had a loss. The bank and the group has also a positive cash flow of this. The bank also has an impaired capital of negative 504 million. The capital adequacy ratio is 7.22 negative. And that was even a downward from the 2023 negative 9.9%. As stated in note 4, these events or conditions, along with other matters as set off in note 42, indicates that a material uncertainty exists that may cast significant doubt on the bank and the group's ability to continue as a going concern. Do you see the idea? That's what's happening here. Because the capital adequacy ratio is around 10% or so, you are in negative 7 point something percent. So Deloitte was like, hey, you guys are in negative. Bank of Ghana can revoke your license anytime soon. But the Carl Bank did right issue, as I mentioned last year. And so now they are back. All other things being equal. I mean, we are waiting for the 2025, as they go ahead in that regard. But that is the idea about material uncertainty about going concern. Now, I want you to look at the last statement the auditors made. It says, our opinion is not modified in respect of this matter. So the inclusion of the material uncertainty relating to going concern paragraph does not modify the opinion. The opinion is still the opinion that, the financial statement of Carl Bank, taken as a whole, represents the true and fair view of the entity. So everything is okay. Only that when we look at the things going on in the company and their finances, we don't think they can continue as a going concern. And it is important the auditor brings that to the attention of the shareholders so that in case Carl Bank took a nosedive or takes a nosedive, we have informed you. So if you were a shareholder, you should have sold your shares or do something with your investment. So that is what we mean by the procedure. Are you getting it? Again, the consistency in the 3 different audit reports that we are looking at. Pro forma is pro forma. Okay. So after the material uncertainty relating to going concern, we come to the key audit matter paragraph. What does this do? Simple. This is where the auditor draws the attention of shareholders to significant issues that arose during the audit and how they were dealt with. That is the key audit matter paragraph. So during the audit, what are some of the issues that arose? How did we respond? What did management do? We bring to the attention of the shareholders. It's more or less like we are letting shareholders know that we have worked. There were a couple of things that came up, and these were material. That's why we said significant issues. So it's not everything we are telling shareholders, but those big issues that arose during our audit and how we handle them, we want to tell shareholders about it. That is the key audit matter paragraph. So when you check Deloitte of Scancom PLC, you will see that they explain what a key audit matter paragraph is, and then they mention some of the things that came up. So for the 2024 financial statement, Deloitte raised concern on the mobile money issue. The floats that they were having, that was the only issue they raised. In other words, that was the only significant issue that they encountered during the audit. Any other thing was not significant beyond the that they don't see. Now, it depends on the professional judgment of management. If you look at Bakatili, this company there, this audit firm there, if they see me, they will arrest me. If you look at Bakatili of 2024 SIC, look at them. They listed a number of things: impairment assessment on investment at amortized cost, how the matter was addressed. So they will explain the issue, then they will explain how they dealt with it and how they gathered their evidence to conclude that everything was okay or there was a problem somewhere. Another issue, valuation of insurance contract liabilities. They described the issue and then what they did. Future cash flow projections and various things. That is the key audit matter paragraph. In the auditor's opinion, what are the significant issues that arose during the audit that auditors must know about? That's all. That's all. From the key audit matters paragraph, we go to the responsibility of auditors, responsibility of managers. Yeah. Remember in the engagement letter, when we were accepting the audit, we wrote responsibilities of auditors, responsibility of management when we were responding to the appointment. In the audit report also, we want to remind shareholders what our responsibilities are and what management's responsibility also are. So that is the next paragraph we come to. So you see here, responsibilities of the directors of the company listed, the auditor's responsibility. Primarily, the various things that we've discussed, that, management is responsible. So the directors are responsible for the preparation and fair presentation of the financial statement. They are also responsible for putting in place internal controls, yada, 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 yada. So the various things you know already about the fact that management has to prepare financial statement. Management is responsible for designing efficient and effective internal controls to detect fraud and error if they exist. Those things, we're just reminding them of it. How about the auditors? You know our job already. We are to obtain reasonable assurance about whether the financial statement taken as a whole are free from material misstatement. That's our job, primarily. And then the other things we did, we also identify and assess the risks of material misstatement and anything. So we want to remind shareholders about our responsibilities and management responsibility. It is also to bring in that level of independence. So shareholders understand that, hey, we have nothing to do with the preparation of the financial statement. We have nothing to do with the internal controls and how the financial statement were prepared. We just came in to audit the financial statement and evaluate the internal control. So we are independent. And that's what we want to, again, communicate to the shareholders. Although we have already spoken about our independence in the opinion paragraph, we want to categorically also mention it here. In the case of Scancom PLC, Deloitte, the same thing is going to be there. Responsibility of directors, responsibility of auditors in respect of that. Okay, then we come to other information. Sometimes the other information paragraph comes before these two. Okay, sometimes it comes before these two. So if you check, oh, thought I had this up again. If you check CalBank, let's bring CalBank up again to see. Hallelujah. Eh. Hallelujah. Eh. Give me a sec. CalBank is coming up. CalBank is coming up. CalBank is coming. Hurry up, hurry up, hurry up, hurry up, hurry up, hurry up, hurry up. That's why I should have, brought it in the other slide. Okay. So you look at CalBank here. After the key audit matter, right? Other information paragraph comes. Then again, the responsibilities of directors, responsibility of auditors. Again, it's almost the same text with modification based on the context of the entity we are dealing with that is represented here. After that, it is signed the address of the auditor. We are done. This is the pro forma of the audit report. Any questions? Okay. Sometimes we will have reports on legal and other regulatory issues. Depending on the company we are dealing with, that could be there. It is signed, then you see the auditor's address. In the case of Bakitili, report on other legal and regulatory requirements comes. Then, that is the name of the engagement partner, I guess. Yes. Bernard W.Q. Adade. Then you see the signature coming up, and then the address of the firm. Baka Tili Ada plus Ada. This is a 10, 15 marks question the examiner can ask you. So all I'm doing is operation 10 or 15 marks in the exam hall, where the examiner can get goosebumps and say, hey, this is an extract financial statement. This is an extract audit report. Can you evaluate it? And you are not going to re-prepare the correct one. No. All you are doing is, okay, based on the guiding rules that we just gave. So you can take a screenshot if you want to. Based on the guiding rule we just gave, okay, what should be where? You get the idea? That's the auditor's report. But you see, in the audit report, there are two other paragraphs that may be in the audit report. And these paragraphs are emphasis of matter paragraph and other matters paragraph. Emphasis of matter paragraph and other matters paragraph. Please note, the inclusion of either paragraph does not modify the opinion of the auditor. Okay? But these are other paragraphs that we can bring. So let me take you back into my slide and let's take some one-liner on this quickly. So permit me to take you back up in the book. So you see that in the book, we still have some pro forma of the audit report also there in the book, okay? Just so that you have an understanding. But it will be good to look at those three that we have looked at to help you. Oh, please give me a moment. Let me see if I can bring up this slide. think it's rather up. Whew. This is going concern. Oh, this subsequent event. Please give me a moment. Because I want to just show you something here. Thought I had opened it earlier. Okay, so this is the audit report, the pro forma. If not, I'll just move on. Yeah, okay. This is what I was looking for. I haven't bypassed it. Page 245. Emphasis of matter paragraph and other matters paragraph. What are they for? Emphasis of matter. Please, it's a question the examiner can ask you. 5 marks. Differences between emphasis of matter paragraph or other matters paragraph. So it's part of the reporting area that you must understand. So emphasis of matter. Now, the word emphasis means what? When we say we are placing emphasis on something or we are emphasizing something, it means it has been said or done or mentioned already, and we are repeating it so you hear it well. So emphasis of matter paragraph, the purpose of this is to draw the user's attention to a matter already disclosed in the financial statement because the auditor believes it is fundamental to their understanding. So it is not like we are reporting management to the shareholders, but we just want to draw shareholders' attention on the issue. Emphasis of matter paragraph. Now, the usage of the paragraph is described by ISA 706, and it will come in under 3 examples. So 3 circumstances when the usage is appropriate. 1, when there is uncertainty about exceptional future events. So something is likely to happen in the future. Maybe there is a court case pending. Management has provided for the court case in accordance with IAS 37. Contingent liability, they've done their accounting, there is no problem. But we want to draw shareholders' attention on that. We want to draw their attention where there is uncertainty about exceptional future events. Because maybe the outcome of that case can have a significant impact on the profitability or maybe the going concern even of the entity. So we want to draw shareholders' attention. It's not that management has done something wrong. They've accurately accounted for it, as I mentioned, but we just want to let shareholders be aware because it could be buried in the financial statement, in the notes to the financial statement. But since shareholders will be glued to the audit report, why not? 2, early adoption of new accounting standards. So if there is a first-time adoption or early adoption of a new standard, right? Like recently there is IFRS 18 coming up, which is replacing IAS 1, preparation of financial statement. It's going to be effective 1st January 2027. But an entity can adopt it early, meaning that a company can prepare their financial statement for 2026 using the formats provided by IFRS 18. It doesn't mean they are wrong. They've done the right thing. We just want to bring that attention to the users of the financial statement. Or number 3, when a major catastrophe has had a major effect on the financial position. Like the haircuts that a lot of companies suffered under the domestic debt exchange program. So it can be referred to as a catastrophic event because many companies literally went down the drain because of that event. So we want to tell shareholders about it. Let them form the understanding because it's going to be helping them. That is the idea about emphasis of matter paragraph. So there is no problem. We are not gossiping, if you want to put it. We are not trying to say, oh, management has done something wrong. No, we are only telling shareholders, hey, these things have been done in the financial statements, but we want to just tell you guys about it so you are aware. So that is the emphasis of matter paragraph. Then we have the other matter paragraph. These other matter paragraph are used to refer to matters that have not been disclosed in the financial statement that the auditor believes are significant to the user's understanding. Are you getting it? So, other matters, any other issue that we think of, it's not about it has been disclosed or mentioned in the financial statement, but we think shareholders must know about it. We can bring it there. So maybe management is planning to go and acquire another company. Okay, so they are putting things in place to go and acquire another company. Or management is planning that in the next 2 years they will do a restructuring or something like that. We feel shareholders must know about it. Then we can tell shareholders. So it can guide them in the decisions that they are making, whether to continue to invest in this company, buy more shares, or even sell off their shares and au revoir mon ami, go away. That is emphasis of matter paragraph and other matters paragraph. And that brings me to the end of the pro forma of the audit report. So key takeaways. 1, knowing the pro forma of the audit report and what must be described or mentioned in each aspect of the audit report. 2, understanding that the inclusion of the material uncertainty relating to going concern paragraph, emphasis of matter paragraph, other matters paragraph, does not modify the opinion of the auditor. And then 3, that the appropriateness of the opinion we are going to be issuing would depend if it is in the modified audit report, materiality, pervasiveness, and ability of the auditor to obtain sufficient appropriate audit evidence. That is what you must understand when we talk about audit reporting. 15 marks, or if the examiner gets goosebumps, 20 marks. We could even have 2 areas like the omega question we solved. So let's go back to the omega question. Let me show you something quickly. Where is the omega question? What we solved in the previous session. The omega question was in what? Page 9. So it's a little bit above. 8, 9. Give me a sec. Let me see. Okay, this is what we have solved. Okay, then it's in the other question kit. Yeah. So back to the omega question. Remember we did just the A and B. So now let's look at the C aspect of the omega question quickly. So we saw the issue in respect of the adjustments required. Let me go back into my slide on that. Yeah. So this is the omega workflow we had. So it says, discuss whether the financial statement require amendment, subsequent event, ISA 560. B, describe the audit procedure that should be performed. We did that. So now C, Because the C part is a reporting part. That's why I didn't talk about it, because I wanted to talk about it. I wanted to bring it in after we've done audit reporting proper. So look at the C part. Explain the impact on the audit report should the issue remain unresolved. So quickly, if you remember, the first thing was the lawsuit. And we said that the lawsuit was material. And that it means that they are supposed to, from the supplier. Okay, so what did we say? Let me quickly go through. Sorry, give me a sec. Let's read the story quickly. A key supplier of Omega is suing them for breach of contract. The lawsuit was filed prior to the end of the year, and the sum claimed for by the supplier is $1 million. This has been disclosed as contingent liability in the notes to the financial statement. However, correspondence has just arrived from the supplier indicating that they are willing to settle the case for a payment by Omega of $0.6 million. It is likely that the agreement will be, the company will agree to this. So if you remember, we said this is an adjusting event because the financial statement requires what? Amendment. Okay? Required amendment. So they must make provision for the 0.6. The question the C part is asking us is this. Explain the impact on the audit report should the issue remain unresolved. So we have concluded that the lawsuit, which is outstanding, which the company has not disclosed, has disclosed in the note, but the supplier is requesting 0.6, which the company is likely to accept. And so we said it's an adjusting event. What if management doesn't adjust it? What if they don't amend the financial statement? What will be the impact of that on our report? Again, we go by the rules. Is the 0.6 material? Were we giving some materiality guidelines? Yes, we were giving revenue for the year and then profit before tax. I think we calculated materiality somewhere, for Omega. Yeah, we calculated materiality for Omega. It was 10%. 8% for the profit before tax. And we said it's material. So this is material. But is it pervasive? Nah. I mean, not making a provision for a lawsuit of 0.6 million will not render the whole financial statement useless, will not significantly impact the financial statement. So for the lawsuit side of things, if the issue remains unresolved, we may have to consider the pervasiveness. If it is pervasive, then a diverse opinion. If it is not pervasive, then we can give what? A qualified opinion. Are you seeing the concept here? So it's just like the question we solved under Zillow. But here, we are bundled into three angles. You are doing subsequent events, you are doing audit procedures, and then you are doing the audit opinion. So that's the issue about the lawsuit. How about the warehouse? Omega Limited has 3 warehouses sited in different locations. Following extensive rain on 20th February, one of the warehouses was completely flooded, and as a result, all inventory in the warehouse, valued at $1 million Ghana cedis, was damaged and has been disposed of. The insurance company has already been contacted. No amendment or disclosure has been made in the financial statement. What did we say? We said this is a non-adjusting event, so it doesn't require what? Amendment of the financial statement. But it is a material event, because when we did the materiality of the cost of the inventory, 13% to the profit before tax. So it is material. So although it is a non-adjusting event, it is material. So they are supposed to disclose it in the note. The question the examiner is asking in the C aspect is, what if management decide not to disclose it in the note? What will be the impact of that on the financial statement? Again, we need to assess whether the disclosure is material, pervasive or not. Because if there is a disclosure in the notes that the company doesn't make, does that render the whole financial statement useless? Not really. Okay, not really. So in this case, if it is not material, it's material, one, but if it is not pervasive, then we can issue an except for opinion as well. That except the disclosure of has not been made in the financial statement. The financial statement taken as a whole, and the note represents the true and fair view of the entity. You get the story? So again, not all questions will we just jump and say, oh, a disclaimer opinion. Oh, a diverse opinion. Sometimes our answer has to be a conditional answer. Like I keep saying, that, oh, it is material, yeah? But is it pervasive? If it is pervasive, adverse opinion, diverse opinion. If it is not pervasive, then except for opinion. And you must write your answers from the two angles, not just one. Because one will mean incomplete answer that you are providing. That's the issue there. Finally, the accounts receivables. Right? The accounts receivables. A customer of Omega has been experiencing cash flow problems, and its year-end balance is 0.3 million. And so if you remember, we said this should be treated as an adjusting event, right? The accounts receivable. We mentioned that it is an adjusting event in respect of that because they have to write it off. Or the company must make provision for it. Because in the question, we are told that the receivable balance has not been adjusted for, although the customer is facing difficulty. So it is either they will write it off as we discussed, or they will provide for it. Now, the question is asking, what will be the impact on the audit report if the issue remain unresolved? If management says, hey, we won't make provision, because of the reason they gave, that, oh, Omega believes that as the company has been trading for many years, they will receive some, if not full payment from the customer. So on that basis, management said, Mbano, we will not make any provision for that 0.3 million. Neither will we write it off. So what will be the impact of that on the audit report? Again, that is account receivables. Is it material, the 0.3? Did we do calculation for materiality for the 0.3? Yeah, we did the calculation and concluded that it is material, if you remember. Yeah, material. Oh, no, we said it wasn't material. Okay. Then if it wasn't material and management decide not to do anything, then it won't have any impact on the financial statement. Because 0.3, okay, 0.3 million divided by the revenue of 78 million times 100, or 0.3 million divided by the profit of 7.5 million times 100. So what do we have? Let's just confirm what we did in the previous session. 0.3 divided by 78 times 100, 0.4%. Okay? If we work it on the profit, 0.3 divided by 7.5 times 100, it's 4%. It's below the materiality threshold. So per the materiality guideline, it's not material. So if it is not material and management said they won't do anything about it, we also leave it. So it will have no impact on our audit report. So this is a 20 marks question, as we discussed, but it is loaded with 3 layers of discussion. Subsequent event treatment, ISA 560, audit procedures, which is linked with audit evidence, ISA 500, and then the audit report itself, coming in with ISA 700 and ISA 701 of the audit report. Any questions? That is the end of my discussion on audit reporting. Okay, on audit reporting. Now, let me show you this quickly. Last semester, that's November 2025, Advanced Audit and Assurance. Let me show you this quickly so you understand what's happening. Pass rate was on the overall for the ICA 53.4% in respect of that. Weaknesses. Some wrote the wrong question number for the answers provided. That's something student did. Some candidates' handwriting was so bad that it took a lot of time to make up what had been written. You know, we've spoken about this, right? Handwriting. Because it's a written paper. So if you bring in your Saito handwriting, my goodness, you are in for a big party. So you work on that as well. I think so far, the script we've received, the handwriting, we'll say it's okay, but improve it. Many candidates over-elaborated on answers without considering the marks allocated to the question. And you may, that's what I was telling you in respect of this. You remember that when we're answering the Omega question, I said the whole thing is 20 marks. So when it comes to the write-up of the audit procedures, what do? I said you write 2. Okay? But we were in class, so we were writing like 6, 7, or 8. Okay, we gave a lot of points. But this styling of question that we had, the Omega question, the 3 categories or the 3 segments of the question gives 20 marks. So if you remember, I said 2 marks or 2 points for the audit procedure because the marks will be spread across for the 3 subject matter issues. And that is what the examiner is raising concern on. Because if you are not careful and you keep writing without taking into consideration the marks allocated, then you are going to be punishing yourself on the overall. So please be mindful of that. That is why when we were solving that question, I kept emphasizing that the marks of the question or the marks allocated to the question, we don't have to get goosebumps and write a lot of answers for the audit procedure part. 2, boom, we are done. Poor time management. Yeah, some of you, that's going to be a problem in the exam hall, but I pray for you that you'll be delivered and working within the time. But the only way that can work practically is if you really understand what you're doing and making sure that you stay within the ambit of the context of the question. That's very important. Disorganized communication and lack of focus. Indicating inadequate preparation and weak question interpretation skills. Some people were doing Nsemunu. Do you know Nsemunu? Nsemunu is writing things that you're not supposed to be writing, or you are writing something that logically doesn't make any sense. So you got to be careful because this is advanced audit and assurance. Okay, now look at the structuring. Question 1, bordered on ethical issues, 10 marks, as we have done ethics. Question 1B talked about Okay, we're still relating to ethics, acceptance of engagement there in respect of that, which we've also spoken about. Question 2 was on audit risk, 10 marks. We've also discussed audit risk, right? So you are seeing 10 marks. As I said, either the examiner will do business risk or audit risk. If the examiner wants to get excited about the exam in respect of that. Hey, give me a sec. I wanted to make sure I'm in the right slide. So discussion of the importance of risk assessment at the planning stage of the audit. Question 3 bordered on communicating with those charged with governance, controls, audit reporting, consideration, appropriate. So this is the reporting part, what we just did. That's question 3 for 20 marks on audit reporting. Question 4, approach public sector issues, which we will come to. That's our next discussion. 20 marks waiting for us in the exam hall. And then the question 5 comes to some of the other issues that the examiner is going to be bundling in that regard. So, as I say always, yes, look at the past questions, but you are looking at the past questions to see the structuring of the questions, that kind of vibe. It's not like, oh, you are answering the past questions so that no. So you need to understand the principles well. Once you understand the principles, then you'll be in a comfortable lead to be able to go to the exam hall. Because one of the things that we do even at the end of the day, after the audit report, is, let me talk to you about this quickly. When the auditor finishes his work and issues the audit report, among other things, what is going to be happening for the most part is the auditor will also write a report, a management letter, and give that to management. And in that communication to management and those charged with governance, the auditor is going to raise concern on some significant internal control weaknesses and make recommendation that, oh, during our audit, we saw A, B, C, D. And we think you are supposed to put in place A, B, C, D to management. Now, here is the deal. What if we issue our audit report? Okay, so we issue the audit report. Then after that, something happens. What do? And so we call it the passive and active responsibility or duty of the auditor. From the time we accepted the nomination to the time we issue our audit report, the auditor is going to be active. So from acceptance, give me a sec. From acceptance, I think I will just have to. The app I'm using, I have upgraded to a new version of the app, but I think that's what's misbehaving with my style of writing. Maybe I have to downgrade it to the old version. And I don't know. So from acceptance to issuing the audit report, because this upgrade is messing around my thoughts. It's not good, cry. The auditor is going to be active, looking for evidence. But after the issuance of the audit report, the auditor has a passive duty. So what happens? Let's say that after Bakitili issue the audit report or Scancom PLC, then something happens. What do? Let me bring this up quickly. So remember in the notes that Bakitili issued, or the report that Baketele issued, they said, oh, except the subsidiary investment in associates, that kind of thing, everything is okay. What if after that something came up or something comes up which undermines the report we have issued? Now, practically, what happens is that in that circumstance, because the auditor will not be active, but is passive, meaning that the auditor will still be lurking around, will still be monitoring things, will still be looking at events, so that if there is an information that arose that is significant, which if it was available at the time that we were preparing to issue the audit report, we would have requested an amendment of the financial statement. The auditor will sit down with management and discuss the issue. Hey, this issue has come up. What are you supposed to do about this? Then, in most cases, there will just be a communique that the entity will issue. So, the auditor will not redraw the audit report or have to issue any new audit report. There will just be a directives that a communique that will be issued to let people understand that a new information has what? Come up. And if that information come up, the financial statement would have looked like this. It's just a further information to the audit report that has been issued already. That's the thing there. Because we've already issued our report. And we didn't get that information as at the time we were issuing the report. Okay, so now that that information has come, yes, it has an implication on the financial statement. Okay, so what will be the effect? Management will communicate that to the shareholders through just a communique, and the auditors will ensure that that communication is done. So it doesn't undermine the audit report that has been issued previously. Because the audit report that has been issued, or that was issued previously, was based on the information we had at the time of the issuance. So now that there is a new information, there will just be a further communication that will be issued to bring some clarity to the financial statement as a result of the new information that has been issued. This is what you must understand about audit reporting, and that is all about audit reporting. Any questions? Any other questions for me? So in bringing back my slide, here, this diagram, here, we've dealt with acceptance. Okay? We've dealt with acceptance. Number 2, we've looked at audit planning and risk assessment. Again, there are questions because these are all specific aspects of the syllabus. That's why we've discussed them. 3, we've looked at audit procedures and documentation. 20 marks waiting for us in the exam hall. 4, we've looked at the audit reporting. Going concern, subsequent event, the audit report itself, the opinion that we express in the audit report, other information, how we carry it out. That's it. The next part of our discussion will focus on the public sector issue. 20 marks coming in there. Public sector issue. And there we're going to be looking at the types of public sector auditing and the general public sector auditing issue. From there, we'll go to governance, in the public sector, 10 marks. Then from there are other skirmishes in the syllabus like non-assurance services, due diligence, forensic auditing, review of prospective financial information. Then, au revoir, mon ami. We're on our way to glory. Like glory, glory, Man United. Now they are doing well a little bit. So that's the idea in respect of that. So you're going to be sent a question or some questions to work on in respect of that. The last week assignment we received I think a script from Elizabeth also. It has been marked and I think has been sent to you also, or will be sent to you in respect of that. So some set of questions will be made available to you for you to work on. And that is going to be leading us into our revision session as we begin to solve and then go back with some of the things that we need to understand generally at the end of the day. And that's it about my discussion today. So I'll wrap up here. Next week, we'll get into the public sector areas and then corporate governance. So you can actually look at the key summary videos in the mobile application in your advanced audit and assurance course and watch the key summary videos on the types of audit in the public sector and those public sector issues, and then the governance issues as well. So that next week when we come, we have the discussion, then we take some questions and see how practically we can address that as well. But as I mentioned, it's a written paper. So you need to not just say, oh, I understand the topic, but you have to also build your confidence in the way you write out your answers, because that is how you can put yourself in the position to go to the exam hall and pass the examination. All right, so that's it. And God willing, next week we will continue.